Imagine diligently paying your taxes year after year, uh, doing your part, right? And then you discover that someone with maybe 1,000, maybe even 1,000,000 times your wealth is legally paying, well, just a fraction of your tax rate. Now, this is some shadowy conspiracy theory. For many of the world's ultra-rich, it's actually a carefully engineered reality. It's a kind of sophisticated dance with the tax code. Welcome to the Money Debate. Today we're taking a deep dive into something that really, it affects all of us. Why some of the wealthiest individuals seem to play by a completely different set of financial rules when it comes to taxes. We'll unpack the strategies they use, look at the specific mechanisms in the system that allow this big imbalance, and explore some of the proposed solutions. Our mission today is really to give you a shortcut, a way to understand this complex world of wealth taxation and, well, some of the surprising facts behind it all. So let's start by setting the stage, because the sheer scale of wealth concentration we're talking about, it might genuinely surprise you. We're talking about a tiny, tiny fraction of the global population holding just an astonishing amount of the world's wealth.
It's a truly stark picture, yeah. One analyst, looking at India, put it very bluntly: half the country is fighting for crumbs while a tiny fraction lives in unimaginable luxury. And the numbers, they really back this up. The top 10% in India, they capture almost 58% of the national income. The bottom 50%, just a tiny sliver.
Wow.
And this isn't just India, not at all. The sources we looked at clearly show economic inequality is a major global issue. Think about the U.S. America's 745 billionaires saw their wealth explode by, get this, $2.1 trillion. Trillion. That's over 70% growth in just the first 19 months of the pandemic. Their total hit $5 trillion by October 2021. And just for perspective, back in 1990, the inflation-adjusted wealth of U.S. billionaires was $240 billion. There are only 66 of them.
So it's not just that a few people are super rich, it's that their wealth is growing, exponentially. It's a rate most of us just can't even comprehend. It fundamentally changes the whole picture.
Precisely. And a core strategy they use, the ultra-wealthy that is, to achieve this and keep growing while, minimizing taxes, is often called buy, borrow, die. It sounds a bit morbid, maybe, but it's perfectly legal. And it lets fortunes just balloon without actually triggering taxable events along the way.
Okay, let's unpack that. Buy, borrow, die. It sounds simple, almost too simple. How does it actually work for someone with, massive assets? What's the real mechanism?
Well, it really boils down to a key distinction in how most tax systems work. We mostly tax income, right?
Okay.
And realized capital gains, like when you sell something for a profit. We don't generally tax wealth just sitting there appreciating.
Okay.
So, step one, they buy assets. Things that are likely to go up significantly in value. Think big blocks of stock, prime real estate, maybe private companies. Now, as these assets grow in value, those gains are unrealized. They haven't sold anything yet.
Right, so no taxes due yet.
Exactly. The wealth grows, sometimes massively, but the tax bill doesn't budge. Then comes step two. Instead of selling those appreciated assets and paying capital gains tax, they borrow against them. They can take out huge loans using their stocks or property as collateral, often at really low interest rates because, well, they're very creditworthy.
I can see.
And this borrowed money, that's what funds their lifestyle, maybe new investments, maybe even big charitable donations. But here's the kicker. Borrowing money isn't considered income.
So it's not taxed?
Not taxed at all.
Yeah.
They get the cash flow, the liquidity, without triggering a taxable event.
That's fascinating. They unlock the value without the tax hit. Okay, so what about the die part? That sounds final.
It is final eventually, and that's where a really powerful bit of tax code magic happens. It's called the stepped-up basis. When these assets, which have maybe grown enormously in value, are passed down to heirs after the owner dies,
Yes.
their cost basis, that's the original purchase price for tax calculations, gets reset. It gets stepped up to whatever the market value is at the time of death.
Wait, so all that gain that happened before death?
Oof. Wiped out for tax purposes. Imagine an asset bought for, say, $100 that grows to $100 million.
Okay.
The owner dies. The heirs inherit it with a new cost basis of $100 million. If they turn around and sell it the next day for $100 million...
They pay basically no capital gains tax.
Exactly. Because their gain is zero on paper. It means entire fortunes, huge empires can pass from one generation to the next completely tax-free on all that prior appreciation.
So build incredible wealth, live off it by borrowing against it, and then pass it on without the taxman taking a slice of that growth. That really highlights a fundamental difference, doesn't it? How wealth accumulation is treated compared to, say, earning a salary. Now, you mentioned charitable donations earlier. Many of us see billionaires giving away huge sums, and, we assume it's purely altruistic, which maybe it is sometimes. But our Django dive into the sources suggests there's often a very significant tax strategy woven in there too.
Oh, absolutely. Look, genuine philanthropy definitely exists, no question. But the way the ultra-wealthy often structure their giving, it often serves two purposes at once: big tax benefits, and importantly, continued control over the money. Take Mark Zuckerberg, for example. He pledged to donate 99% of his Facebook shares. Not cash, but shares.
Right, the stock itself.
Exactly. That pledge was structured through the Chan Zuckerberg Initiative, an LLC. This allowed him potentially huge tax deductions against his income. And critically, he avoided capital gains taxes on those shares, which had appreciated massively, all while he and his family still largely control how those billions are ultimately used through the initiative.
So it's way beyond just getting a tax deduction for donating cash, like most people might do.
Yeah.
That's a deduction from income. This sounds much bigger.
It is much bigger. For the ultra-rich, the real power play often involves donating highly appreciated stock directly to their own private foundations. Doing this gives them a double benefit. First, they get a full tax write-off for the fair market value of the stock at the time of donation. And second, they completely avoid paying any capital gains tax on all the appreciation that happened while they own the stock. That could be millions, even billions, in avoided taxes right there. Then this private foundation becomes their vehicle. Their family, they continue to manage and direct that money.
So they still call the shots.
Pretty much. Now, there are rules. These foundations have to pay out a certain amount each year, usually about 5% of their net worth, for grants and admin costs.
Only 5%.
Typically, yes. But here's the thing. The foundation's investments often earn much more than that 5% payout, maybe 7%, 10% or more, especially over the long term.
So the foundation itself keeps growing, tax-free.
Exactly. It continues to grow, tax-free, often forever. It's an incredibly powerful setup. It lets them effectively own nothing, control everything. They can channel vast sums towards goals they choose, exert influence, maybe even support political causes or lobby, all without that growing capital being taxed like ordinary income or gains.
That paints a picture of some really sophisticated financial engineering.
Okay, so beyond buy, borrow, die, and these very strategic charitable structures, what other, maybe more hidden corners of the tax system are being used?
Well, the sources point to a whole landscape of what some call giant tax loopholes. These really supercharged wealth accumulation and especially wealth transfer across generations. A lot of these are buried in the complexities of estate tax, gift tax, and something called the generation skipping tax system.
Right.
A key tool here is the dynasty trust, often combined with the generation skipping tax exemption.
Dynasty trusts. That sounds, well, permanent, like
Right.
something out of medieval times. What are they exactly, and how do they help avoid taxes generation after generation?
You nailed it with permanent. That's kind of the point. State laws have changed over time, allowing trusts to be set up that can basically last forever. No termination date required.
Wow. Okay.
And within these forever trusts, they use some really clever strategies. One is called an intentionally defective grantor trust, or IDGT.
Intentionally defective, that sounds bad. It sounds bad, but it's a legal term of art. It's defective for income tax purposes, meaning the person who created the trust, the grantor, still pays income tax on the trust's earnings.
Okay. So why do it?
Because, and here's the clever part, for wealth transfer taxes, estate and gift taxes, the trust is considered a separate entity. The assets are outside the grantor's estate. So the grantor pays the income tax, which further reduces their own taxable estate, while the assets inside the trust grow and eventually pass to beneficiaries, like children or grandchildren, completely free of estate or gift tax. It's a way to move massive wealth down the line without transfer taxes biting into it.
That is intricate. What else? No, you mentioned GOTS earlier, too.
Right, GOTS, that stands for Zeroed Out Grantor Retained Annuity Trusts. Another mouthful. Basically, a parent puts appreciating assets like stocks into a trust for their child. The parent gets paid back an annuity from the trust over a set number of years. This annuity is calculated so its value technically equals the initial value of the assets put in. So on paper, no gift tax is due up front because it looks like an exchange, not a gift. But if the assets inside the trust grow faster than the interest rate assumed in that annuity calculation, which is often set quite low,
Then that extra growth.
the appreciation, passes to the child completely free of gift or estate tax when the trust term ends. And if the assets don't appreciate, well, the parent just gets the assets back. It's often structured as a very low-risk bet for the wealthy family. We know figures like Jeffrey Epstein were setting these up for billionaire clients.
So it's like a heads I win, tails I don't lose situation for transferring wealth appreciation tax-free.
Yeah.
Incredible. Are there other layers to this?
Oh, yes. Layered on top of these trust structures, you often see the use of valuation discounts. This allows the wealthy to claim that the assets they're putting into the trust are worth less than their straightforward market value for tax purposes.
How can they do that?
Well, they might argue that transferring, say, a minority stake in a family business or a fractional interest in a piece of real estate is worth less per share or per unit than having full control, because it's less liquid, harder to sell.
Right. Lack of control or marketability discount.
Exactly. So they might claim a 20%, 30%, even 50% discount on the value of the asset being gifted into the trust. Subway co-founder Peter Buck, for example, successfully used discounts over 50% on timberland he gifted to his sons through trusts. This means they use up less of their lifetime gift tax exemption or pay less gift tax, allowing even more wealth to be transferred tax efficiently. He avoided tens of millions in taxes that way.
Okay, so discount the value going in. What about getting money out eventually?
That brings us to another tool. Irrevocable life insurance trusts, or ILITs. These trusts are set up specifically to own massive life insurance policies on the wealthy individual. The trust pays the premiums. When the individual dies, the life insurance pays out a huge sum, potentially tens or hundreds of millions, directly to the trust.
And that payout?
Typically completely free from both income tax and estate tax. And because it's inside the trust, it can benefit multiple generations without being taxed again. It's another powerful way to inject tax-free liquidity into the family fortune for generations to come.
It genuinely sounds like the system, through all these very specific, complex tools used together, is almost perfectly designed to make it incredibly hard to tax large fortunes as they grow and pass down.
Yeah.
It's clearly the domain of highly specialized advisors.
And it's not just a domestic issue either. This whole challenge has a huge global dimension. Tax evasion, tax avoidance, they've long been fueled by offshore tax havens. Our analysis suggests something like the equivalent of 10% of the entire world's GDP is held offshore in these havens.
10% of global GDP.
That's the estimate. And for some regions, like certain Gulf countries, it could be as high as 60% of their own GDP stashed away offshore.
So this isn't just about fixing, say, the U.S. tax code. It's an interconnected international system. How do these offshore havens fit into the picture for, minimizing taxes?
Well, big leaks like the Panama Papers, the Pandora Papers, they really ripped the lid off this shadow financial world. They showed exactly how world leaders, billionaires, celebrities use complex webs of shell companies and trusts set up in places like the British Virgin Islands, Panama, Switzerland.
To hide wealth.
To hide wealth. Sometimes to launder money, and definitely to engage in tax avoidance or outright tax evasion. As Imran Khan, the former Pakistani PM, put it bluntly, these offshore accounts often protect these crooks. Now, there has been some progress, thanks to things like the automatic exchange of bank account information between many countries.
Okay, so countries are sharing more data now.
Yes, and that's made old-school offshore tax evasion harder. It's estimated that kind of evasion by individuals has shrunk by about 2/3 over the last 10 years, which shows that when there's political will, things can change.
But new problems pop up.
Exactly. New challenges are always emerging. We're seeing a rise in what's called tax competition between countries. Nations are actively trying to lure wealthy individuals and their capital by offering special preferential tax deals. Think golden visas or passports in exchange for investment, or special low tax rates on foreign income, or for specific types of high earners like scientists or star athletes.
So countries are competing to offer the best tax deals.
They are. Some European countries, the UK, Switzerland, they have these regimes. The estimated cost just in lost tax revenue from these schemes in Europe is around $7.5 billion a year. The average benefit for someone using these schemes is over €34,000 annually. This kind of competition really fuels inequality because it makes tax systems less progressive. It basically creates incentives for the rich to shop around for the lowest tax bill.
So it becomes a global race to the bottom, not just for corporate taxes, which we hear a lot about, but for taxing wealthy individuals too. That creates a real tension, doesn't it,
Yeah.
between national interests and global fairness. And this isn't just some abstract debate about accounting rules or global finance. The sources we looked at are pretty clear. This extreme concentration of wealth and the ways taxes are minimized on it has really significant consequences for society, for democracy, for everyone's economic opportunity.
Absolutely. One analyst put it starkly. This is not an accident, it's policy. The argument is that the system, as it exists, is often seen as being deliberately wired to preserve elite advantage. You see powerful groups funding political campaigns, shaping media stories, lobbying heavily against any tax changes that might lead to more redistribution.
Right.
And the consequence is straightforward. When the very wealthiest pay proportionally less, the tax burden inevitably shifts. It falls more heavily on working families, on the middle class, or the alternative is less public money available for everything else. Schools, roads, healthcare, scientific research, you name it.
Yeah, that makes sense.
And this leads to much deeper questions, doesn't it? About basic fairness, about whether our current economic models are sustainable in the long run. You get critiques of capitalism, raising concerns about, well, exploitation, arguments that significant economic inequality forces people into situations where they have little choice but to accept poor working conditions or low wages. And then there are the environmental concerns, too. The idea that capitalism's inherent drive for constant growth is fundamentally at odds with a planet of finite resources, that it inevitably leads to depletion and degradation.
So what starts as a discussion about why billionaires pay less tax quickly spirals into these huge fundamental questions about the kind of society we have, the economy we want, and even our relationship with the planet. It really shows how interconnected everything is. Okay, so given how complex and frankly how significant these issues are, what's being proposed? What are the potential solutions on the table to try and create a tax system that feels, well, fairer and works better for society as a whole?
Well, our deep dive points to a few main directions for reform. One is pretty direct. Go after the specific loopholes we talked about. Things like reforming the estate, gift, and generation-skipping taxes. Closing down the more aggressive trust strategies, maybe limiting valuation discounts, just tightening the rules.
Makes sense. Fix the known problems.
Exactly. Another more ambitious idea that's gaining traction is a minimum tax, specifically targeting global billionaires. One proposal suggests a tax equal to just 2% of their total wealth each year. Just 2%.
1% of their wealth, not income.
Right, on their total wealth. The estimates suggest even that small percentage could generate around $258 billion globally every year. And the argument isn't just about the money, though that's significant. It's framed as a way to put a brake on runaway inequality to sort of democratize wealth ownership a bit more.
Interesting. What about the international angle? You mentioned cooperation helped reduce offshore evasion.
Yes, strengthening international cooperation is seen as crucial. The automatic exchange of bank information was a good start, but the next steps could involve sharing information on who owns real estate across borders. Or getting much tougher on shell companies, maybe creating global registries of beneficial owners so you can see who truly owns what.
So more transparency.
Much more transparency. And some even propose things like anti-exile taxes. The idea is if a very wealthy person has lived in a country for a long time and benefited from its system, and then they move purely for tax reasons.
They might still owe some tax back to their original country.
Exactly. For a certain period, perhaps. It's controversial, but it's being discussed as a way to counter that race to the bottom tax competition we talked about.
Okay, those are mostly focused on taxing the wealthy directly. What about ideas like universal basic income, UBI? We hear a lot about that.
Yeah.
How does it fit in?
UBI is definitely part of the broader conversation, often seen as a potential complementary tool, part of a wider social safety net. The idea is providing everyone with a basic financial floor could free people from immediate survival pressure. Maybe give them breathing room to retrain if their job disappears due to automation, or to start a small business, or just participate more fully in society.
A safety net,
It's
basically.
a safety net, yes. Proponents argue it could be a buffer against job losses from AI and automation, helping people adapt. But there are cautions, too. Would the UBI payment actually be enough to live on? Could landlords or businesses just raise prices, effectively capturing the UBI money?
Right, the inflation concern.
Exactly. And UBI on its own doesn't necessarily change the fundamental ownership structures or power dynamics in the economy. It doesn't directly address who owns the capital or the means of production. Though, the Alaska Permanent Fund, where residents get a dividend from state oil wealth, offers an interesting example. Alaskans tend to see it not as welfare, but as their rightful share of a common resource. That framing has helped its political durability.
So,
It seems, while the challenges are huge, really complex, there are concrete ideas out there. There are ongoing efforts to reform the system, both domestically and internationally. It really underscores that the way things are now isn't, inevitable. It's not like the weather. It's the result of policy choices, priorities, and, well, maybe a lack of political will sometimes.
Wow. From the clever strategies of the ultra-rich, the buy, borrow, die, the foundations, to the whole global web of tax havens and these complex trust structures, and finally to the potential fixes on the table. This deep dive has shown a really complicated picture, hasn't it? Where huge fortunes can be built, kept, and passed on, often with surprisingly little tax involved along the way. Understanding how this all works, I think, isn't just for finance nerds. It feels like the essential first step if we want to have a more informed, more productive, and ultimately maybe a fairer conversation about how our economy works. What really stands out to you from today's discussion? What's the one thing you'll be mulling over? Thank you so much for joining us on The Money Debate.
If you found this deep dive valuable, insightful, maybe even a little eye-opening, please do subscribe to our channel. It helps us keep bringing you insights on these really critical issues shaping our world. And just a reminder, the information we share today is for entertainment and informational purposes only. It should definitely not be considered financial advice. Always, always consult with a qualified financial professional for personalized guidance about your own situation.